Michael Burry just destroyed the Federal Reserve in his latest tweet. The American dream could soon turn into a nightmare as we witness the end of its better days. All hope seems lost, but revival could have been possible if Michael Burry's advice had been sought after by the government. He has always called crises years ahead of their unfolding, which the US government always seemed too blind or stubborn to see. He is being very vocal and bold in condemning the United States Central Bank, the Federal Reserve System, for making unwise decisions, lacking knowledge and financial history, showing shallow insight and severe inability to recognize critical times. With his track record of investing success, some think he possesses something of a sixth sense. What is certain is that he seems more credible than the central bank itself. Many people today appear to have given up hope of ever becoming financially stable or secure, even though one of the central ideas behind the American dream is the belief that anyone with enough time and effort can achieve material success. Up to 75% of Americans currently believe that it is simpler to move down the economic ladder than up. The government cannot just sit back, waiting for disaster, without looking for solutions, right? So what did Michael Burry exactly have to say about the Fed, and how did everyone react to it? Keep watching this video to find out. Let's take a step back and start from the beginning. To the aid of the wealth of Americans, there exists the Federal Reserve System, or Fed for short, retaining central control of the American monetary system in order to alleviate financial crises. This bank has three main objectives: stabilize prices, maximize employment, and moderate long-term interest rates, through which it performs its duties of regulating banks and other financial institutions. However, it is now slowly losing control of the steering wheel because it's been unable to direct the country's economic future. Although the bank recently declared that high inflation would worsen and the unemployment rate would increase, it has no real sense of the actual magnitude of the impending recession. Even though citizens expect the Fed to provide the best information on where the US and global economies are heading in the coming months, the bank's president, Jerome Powell, appears to have no accurate answers but mere speculation, declaring to be unsure of the state of the economy. The Fed's fight against inflation has thus been regarded as slow and yielding little results. This has opened the floor for increased criticism by workers and business owners due to the high interest loan rates affecting their day-to-day living. There are hardly any parallels to look back to. The economy has almost never been in this position, with food prices increasing globally, high fuel costs, and supply chain disruptions ignited by the war between Russia and Ukraine and the worsening crisis in China. In September, Powell announced the fifth increase in interest rates, designed to ease the pressure and slow the economy by reducing demand, following an increase in the lending rates by 3%, which has been the highest since 1982. Powell has further hinted that there might be an additional one lurking before the end of the year. However, some economists have found this decision to be unfavorable to the market, as it risks tipping the country further into recession and with an increased level of unemployment. While in Powell's words, the dangerous ramifications of losing the country's economy to inflation entirely far outweigh the risk of pushing it further into recession. Presidents of other central banks have supported Powell's decision by stating that it would be pure wishful thinking to lower the inflation level without raising rates to restrain the economy. Some also believe that inflation has reached its peak and will start to decrease. The aggressive increase in interest rates that the Fed has put into place to counter inflation have led the country into an era of widespread joblessness. The forecasted unemployment rate by the end of 2023 will be from the current 3.7% to 4.4%. This is estimated to be 1.2 million unemployed people. If the system is ineffective and is not producing answers, how can we find out if the economy will turn out fine? Michael Burry, world-class investor and billionaire who bet against the system before it crashed in 2008, gave the Fed a piece of his mind. For a little backstory, Burry is an American medical practitioner who left medicine to pursue his hobby, investing. He developed a strong reputation in the financial industry thanks to his success with value investing. He has done so by buying tradable financial assets that appear underpriced based on rigorous analysis of businesses' fundamentals through their financial statements. The overall state of the market and his discussions on the stock market in the year 1996 attracted the interest of financial companies of the likes of the White Mountain Insurance Group and Vanguard. With his strong understanding of intrinsic value, Burry has built an empire on his skillful analytical thinking and on the principles of Benjamin Graham and David Dodds, who were the founders of value investing. Since the start of his career and until closing his fund, Burry documented total returns of 489.34% against the S&P 500's total 3% in the same time interval. Michael Burry has warned the Federal Reserve about rising inflation. He loudly refused to applaud the Biden administration and the central bank for trying to reduce inflation by increasing rates, because he believes inflation happens in spikes, and temporary comfort is not a sign of an improving economy. In 2021, Burry indicated an unprecedented rise in asset prices and warned that this could lead to a terrible crash, giving further hints about the economic meltdown. In 2022, Burry further elaborated on the possibility of the mother of all crashes as he showed a graph of the S&P 500's intense decline since its last all-time peak in January. He cited examples of 2000 and 2008 when the dot-com and the real estate bubbles caused the meltdown of the stocks. He noted the crashes in cryptocurrencies and some special purpose acquisition companies, or SPACs, and other market crashes are happening the same way they happened in previous years. He even indicated that the SPAC market's meltdown was the beginning of a bigger economic crash, and the economy has not hit bottom yet, but is just on its way. Further hints are the decline in investment returns in the different stock exchange markets such as the S&P 500, which has plunged by 19%, the NASDAQ, which slumped by 27%, and the Bitcoin price, which has dropped massively below 66% from last November's peak at $19,000. In his tweet, Burry exclaimed that the Federal Reserve has no intention of reducing inflation, but only buying time with the increase in prices till the stocks tumble and the consumer spending dries off. Thousands of Americans have supported Burry in this claim. Most Americans believe that the inflation value being released to the public are lesser than what the actual value is. It rose to 8.5% in March and showed little evidence of reversing. In his tweet, which Burry deletes shortly after posting, he reiterates his fears for the markets and economy for what is left of the year, believing that there will be further consumer inflation by December. He suspects that by the end of year 2022, many citizens will have spent all their savings, while others will have greatly increased their credit card debt with little way to repay it. Burry called the Fed out on Twitter, warning them to reconsider the option of rapidly cutting interest rates once inflation subsides, recounting a similar decision made in the past, which caused the stock prices to sharply rebound and created a level of inflation that took the country years to phase out. He also accused the Fed of not clearing out their balance sheet, which means reducing their security holdings by selling out accumulated assets to reduce the amount of money circulating in the economy at a given time. The central bank was to sell over $30 billion worth of treasuries and $17 billion worth of mortgage-backed securities every month. This is a standard maneuver known as quantitative tightening. But instead of clearing out these securities, the Fed added more and more to its pile since. In his opinion, the central bankers are ignorant of financial history and do not learn from the results of the decisions made in the past, citing examples of mishandling from international financial crises of the previous years. Is Burry right about his predictions? It can't be concluded quite yet. But given his credibility and the success of his previous projections, the odds are stacked in his favor. Michael Burry, however, is not the only one to declare his stance on the impending recession. Other famous investors and financial analysts have shared their opinions regarding the Federal Reserve. Given recent events, Steve Hanke, an economics professor at Johns Hopkins University, believes the probability of a recession is closer to 80% than the 50% predicted by the Federal Reserve. He also adds that the Fed has, over the years, failed to manage inflation by managing the core factor, which was controlling the large supply of money in the U.S. economy. ARK Invest's Cathie Wood has issued an open letter to the Fed, stating it has shocked not just the U.S., but the world, and raised the risks of a deflationary burst, while Jeremy Grantham, veteran British investor, stated the market is in a super bubble and warned all on the impending collapse of stocks, bonds, and housing. Referencing financial history, the super bubbles of the past have been followed by a market decline by at least 50%. In his opinion, he concluded that each cycle is unique and different, but the worst is yet to come judging from these parallels. Other financial analysts and economists such as Robert Kiyosaki, Nouriel Roubini, Harry Dent, and Mark Mobius have all spoken in favor of Michael Burry's opinion. Burry has protected himself from any impending disaster by selling off his whole stock portfolio. Scion Asset Management sold over 11 stock positions, including Nexstar Media Group, the Google parent Alphabet, Bristol Myers Squibb, and Facebook parent Meta. Is there hope for a change? What does the future hold? Let us know your thoughts in the comments.